Recording in progress.
Good evening, everyone. I, on behalf of the Women Members Empowerment Committee of ICAI, welcome you all in the Sky High Symposium Series 33. Sky High Symposium is a Wednesday series of programs conducted by the committee for the women and by the women. It is one of the Women Members Empowerment Committee's initiatives to not only disseminate information to women members on technical updations and non technical skills, but also to empower and inspire women members to come at forefront and realize their verbal skills at public forum. Today, we are going to cover session on M&A, tax and regulatory aspects, and conducting internal audit of educational institution. For our first session on M&A, tax and regulatory aspects, we have with us CA Deepa Dalal and CA Manali Mehta. To give a brief introduction of CA Deepa Dalal, she is a partner in M&A tax at Deloitte with an experience of over 2 decades. She has worked on complex restructurings for large listed enterprises and PEs, including both domestic and cross border transactions across various sectors like data center REIT, digital e commerce, telecom, infrastructure platforms, and EV space. To introduce CM Manali Mehta, she is a senior manager in M&A tax at Deloitte with over a decade of experience. She has worked with eminent MNCs, Indian corporates, as well as PE clients, including both domestic and cross-border transactions across various sectors, including technology, telecom, quick service restaurants, pharmaceuticals, healthcare, and consumer products, etc. They have an extensive experience in advising industry leaders in the area of acquisitions, divestments, mergers, demergers, corporate restructuring, reorganizations, foreign investment consulting, and reorganizing promoter holding structure from a succession perspective. Now, I would like to give the forum to the two to enlighten us on the topic.
Thank you, Priyanka. We will just display our sides. Good evening, everyone. It's pleasure to be with you here today. So, Manali and me will quickly take you through some of the things which we have curated for you for this session, and we'll be happy to take up any questions. Yes, Manali, we can go forward. So, what we are going to do is going to cover the at a very high level what are the key things which we look at from an M&A perspective, and we are going to give you an introduction and an insight to what we do every day and a peek into what all are the issues or things which you look at when you read every day a newspaper. You look come through and a lot of M&A deals which are happening, and some of it we have tried to capture here as to what are the key pointers we look at when we work on such things. So, typically we have seen that corporates or PE funds owned organizations, they do M&A for various reasons. And something as simple as structure rationalization, that we saw that law changes, sometimes multiple tier of holdings are not permitted, say from Companies Act perspective, or consolidation of various businesses which need to align together to go to market together, sometime backward forward integration. For all of these reasons, multiple reasons, there could be a structure rationalization. Sometimes you need to split the businesses due to diversification to enable you to get into multiple segments. And we have all seen that larger organizations, they have different entities. Like we have our own India-based MNCs like Reliance, Tata, Aditya Birla, all of these have different entities focused into different things. So at some point of time, they all have undergone either amalgamation or a demerger to focus into separate strands of businesses. Then you could also actually exit some of the businesses or get into a global reorg. Say, global organizations, you would have seen that, for example, PNG exiting certain part of their business, and therefore that needs to be carved out and sold. At times you also want to get into an IPO. We as India have seen so many IPOs coming through, which are India-based startups. So for all of these reasons, you need to reorganize to be in to be into an efficient structure and to give visibility to investors. So for all of these purposes, you could have M&A, and these are just some of the things which we have outlined. There could be many more reasons why you could do a reorganization or a restructuring of your existing structure. Let's go ahead, Manali. Yeah, Manali, you want to take up the kinds of reorg?
Yeah, sure, Deepa. Thank you so much for laying out the context as to, why there's a need for M&A. And, depending on the need of the hour, there are various ways how one typically would look at a M&A transaction. And, to put it down into two broader buckets, one could say that there are various ways to do acquisitions and there are various ways to do restructuring of the businesses. When we say acquisitions, it could either be a business acquisition or somebody who's interested in doing a share acquisition. When I say business acquisitions, again, it can be broken down into two buckets. One is where you say that you are actually going to be acquiring a business which is running, it's an ongoing operation, and as a buyer who is interested in running the business on as is basis, I would probably prefer to go ahead and do a business purchase by way of a slump sale. Another way to do a business purchase is where, a buyer who is not really wanting to acquire the whole of the business, but may be interested in few assets or, few identified pieces, which is going to be like an add-on advantage to the buyer. And they may look at acquiring it in a piecemeal basis or, cherry picking basis of few assets. That is typically termed or coined as an itemized purchase or sale. That's about business purchase. In terms of share purchases, it's like straightforward, where you are interested in acquiring whole of an entity, including everything that is housed in that entity. Typically, a share purchase route is preferred. Another area of M&A is restructuring. And this could be an internal reorganization or restructuring versus an external one where you have third party interested in the whole realignment or restructuring. Typically or very commonly seen approach is doing a merger or a demerger. Merger, which we also commonly call as amalgamation, or a demerger route. In case of mergers, you typically would consolidate two businesses into one. So it could be merger of one entity into another entity where both the entities are combining their whole businesses, or it could be merger of multiple entities into one as well. Whereas in demerger, what happens is there is a focused one part of a business, or you're not wanting to acquire or interested in carving out your whole of business operations, but maybe a portion of it is where you would typically see a demerger. Vis-a-vis that, when we look at internal restructuring, that could be done by way of a capital reduction where you distribute excess assets or capital to your shareholders, or it could be other modalities like buyback or those kind of things which can be done. So broadly, this summarizes various restructuring modes which are typically seen in the market in India. And today we are going to mainly focus on two parts. One is business purchase, which is by way of slump sale or itemized sale. And the second part is mergers and demergers. Next, what we've listed here is, what are the key frameworks which are going to be material while looking at mergers and demergers. Deepa, you want to just chime in?
Yes, thanks, Manali. So when you look at the various regulations which kind of touch upon when you do an M&A transaction, these are only some of it, and there could be much more depending on which sector and what kind of reorganization are you looking at. Um, so basically, if you see some of the common bits which will run across is Companies Act, uh, direct tax, indirect tax, and stamp duty. This will remain irrespective of the kind of entity that you're looking at. Typically, all corporate entities would need to go through this. Even LLPs will have to go through ROCs. So all of these regulations would fairly touch upon all kinds of M&A. Additionally, if you have non-residents or underlying entities are non-residents, for example, outbound investments, there could be also overlay of foreign exchange regulations, which could have an impact. For entities which have listed securities, either debt listed or equity listed as well, there is SEBI, which overlays on those transactions. Now, whether a takeover code gets triggered or not, that is also one of the aspects. But there are many other aspects where SEBI governs approvals and procedures on reorganizations. Additionally, there is CCI. As we all know, you would be reading in newspaper, CCI regulations are undergoing some changes, or rather set to undergo changes, and they have already, they are aggressively looking at what organizations are doing. And, on M&A, they are having a specific eye on various things. So CCI is whether it is a notification or approval depends on the nature of the transaction, the quantum, etc. But these are the broad regulations which cover. In addition to this, depending on, like we discussed, the sector, for example, for anything to do with finance sector, for example, NBFC, CIC, etc., you would also have additionally RBI as the governing body and those regulations as governing regulations, which you will need to check to see the permissibility or conditions which need to be satisfied. And for additionally for any other regulated entities, for example, something which is regulated by DOT or information broadcasting, all of those will need to be separately adhered to. Now, all of these things these regulations need to be read harmoniously, and whichever structures we are looking at, these regulations could have an impact. For example, these could have a fiscal impact or a timeline or a approval impact. So for direct tax, indirect tax, and stamp duty, the bottom line which you can see, these are the ones where you could have a transaction cost impact. That means that sometimes if you have immovable property in any reorganization, then you would need to see what is the stamp duty cost coming to. Even a leasehold property with MIDC or GIDC or such authorities could have a cost because a premium associated on the transfer. Indirect taxes, whether GST credits move, whether there is a transaction which is subject to GST. For example, itemized transfer of assets is subject to GST. As a simple as a transaction like indemnity, we all have read newspapers that there is a case which is being filed um, for the arbitration which happened in Docomo case for against the GST levy which has been put. Now, all of these are transaction linked. So we need to see whether indemnities are liable to GST, like these kind of issues. They all impact the transaction cost ultimately. And of course, on direct tax, you would have directly the losses moving, any MAT credits, any movement of benefits, that is, the benefits which were existing already. All of those things are important to be checked, and these all laws are what you will discuss some of these in our slides coming forward.
So, moving to the first case, which we want to discuss on the modalities about business acquisitions. Uh, Coming on to, slum sale, and which is more commonly referred or known as business purchase or sale. And we typically, hear very frequently that there are certain businesses being acquired. More so, recently in the news were Dalmia Group intending to acquire the cement business from Jay Prakash Associates, or Mahindra looking to acquire Rivigo's B2B express business for about 225 crores by way of slum sale. So, what is it that we mean by way of slum sale, and how is it differentiated from an asset to asset transfer? How does it work? So, looking into the concept of slum sale, and it is called as a business transfer. What happens in case of slum sale is that there is a business which is identified to be transferred to another entity. There are certain key elements to it, is that the business is being transferred on a going concern basis. When you say going concern, it means like uh, how it was operating in the transferor entity. On same basis, you will be able to operate the very next day in the transferee entity. So it's more like a shift on a lock, stock, barrel basis. The transfer is for a lump sum consideration. So basically, when I transfer business assets, maybe it could comprise of plant and machinery, contracts, employees, lot of things which you would need typically to operate a business. But I will not be identifying values to each of these assets and thereafter arriving at a total consideration. For a transaction to qualify as a slump sale, one of the key element is that the consideration is a lump sum consideration, where a buyer probably says that, for, say, for example, in Dalmia, when we say cement business, for the whole cement business, I'm paying you XYZ amount rupees for acquiring the whole business. That is a lump sum consideration. The consideration can be settled by a buyer by way of cash, or any other modalities, by any other consideration in kind or issue of own shares. It could be any form of settlement of that consideration. An undertaking, so basically, in order to qualify as a business, one needs to transfer a business undertaking, right? And undertaking is defined under under the demerger definition. The slum sale concept derives the undertaking definition from the demerger definition. And undertaking is defined to include a part of an undertaking, a unit or a division of an undertaking. But the principle remains that whatever is getting transferred should constitute as a business activity when looking at it as a whole. So I may, have 3, 4 divisions in a company, and I may be transferring one of the division, but is that division capable of operating itself as a business. That is a key criteria when you are looking at a slump sale. Moving to what are the key considerations in case of slump sale. So whenever, a business, so say for example, here we are saying that seller company is transferring BU2, which is a business undertaking, to a buyer. What happens is, from seller perspective, they will have to compute capital gains on this transfer of business undertaking. There is a prescribed mechanism which is there under income tax laws to compute this capital gains, for which one needs to arrive at the net worth of the undertaking. For the net worth, there needs to be a certificate given by a chartered accountant, which needs to be prescribed at the end of the year while filing the tax returns as well. For slump sale computation, there is no indexation benefit available. From buyer perspective, there are also a couple of points that, when buyer acquires a business, like we discussed previously, the consideration is a lump sum consideration, right? So when a buyer acquires a business, say for 100, buyer will go and obtain a purchase price valuation report. Now, what is a purchase price valuation report? Buyer needs to record these assets in its books, right? To arrive at what is the value of each of these assets and what it can record in its book as the value of the assets acquired, it will do a purchase price allocation, which is valuation, which is done by a valuer, which will give value of each of the asset. So that is something which a buyer undertakes typically once it has acquired the business, to arrive at what value it should record these assets. Now, it is possible that seller in the books would have a lower book value recorded, say a plant or a machinery recorded at 50. When buyer does a PPA or a purchase price allocation, if it has paid a premium to acquire certain assets, it is possible that this plant and machinery of 50 is actually having a purchase price allocation of 60. So a buyer can actually claim a tax depreciation on this 60 upon acquisition of these assets by way of slump sale. So the tax break is available to a buyer on this higher asset value, which is there as per the PPA. Another important point which is there from a buyer perspective is, in case of a business transfer, if it qualifies as a succession of business where, buyer is going to continue the whole of the business of the seller, in those cases, the buyer also becomes liable to certain specified tax liability of the seller. And this is typically, as per 170, the tax liability is for the in the year of transfer. So say for example, if the transfer is happening in December 2022, then from 1st April 22 to December 22 is one period for which the tax liabilities will move, plus 1 year preceding the date of transfer. So this is the financial year for the year of transfer. You have from 1st April till the date of transfer. The 1 year one previous year prior to the year of transfer is also the portion for which the liability moves on. So in this case, where we say that December 22 is when the transfer is happening, the liabilities from 1st April 21 to 31st March 22 and 1st April 22 to December 22 is what moves to the buyer. So typically, when you are looking at a slump sale and maybe looking at advising a buyer, one needs to see whether, you are a buyer who's going to acquire a business by way of slump sale. One will need to evaluate what are these liabilities of a seller, which may move on to the buyer. So this is one of the key considerations. And from GST perspective, if the transfer qualifies as a transfer of business, there is no GST payable on a slump sale. A couple of more points which one typically would deliberate while doing a slump sale, and it's on a case-to-case basis. But say where, assets are 100, but liabilities are 120, and you are transferring a business having a net worth of -20. but the buyer is willing to pay you a 30 for that business. So basically buyer is paying you for uh, a 30 for a negative 20 of your net worth, and therefore again to the seller is actually 50. In that case, whether for capital gains tax per computation, do you take 50 as the gain value, or do you only take 30 as the consideration what you've received? So these are couple of aspects which typically one needs to see. Also, one of the aspect which is very commonly deliberated or looked at is, when you look at what constitutes a business or an undertaking that is being transferred, certain times in a business there could be certain surplus assets which are there in the business, which may not be very necessary to run the business, but they are currently there in that business. Whether leaving behind those non-core assets, is it fine? Whether it will vitiate the definition of an undertaking, that is something which one needs to focus on. Moving ahead to the concept of itemized sale. Itemized sale is different from business sale from the perspective that it's not a transfer of business. There are certain identified assets which a buyer is interested in acquiring, and it's about only acquiring those specific identified or cherry picked assets. For each of the assets that a buyer acquires, he will have a consideration which is allocated to that asset, and for which that consideration will be settled. So one of the aspect here is when you say it's an itemized sale, it's not really a transfer of a running business or operation. It's specific assets which are identified and bought out. Recently, I think ArcelorMittal had acquired certain port and power infrastructure assets from SR. Likewise, in terms of itemized sale, there are various deals which keep happening where, uh, the buyer may not really want the whole business, or may not want to take over liabilities or certain assets which it already has in house, and therefore doesn't need everything to start their own operations. In those cases, itemized sale is one of the modality which is looked at. One of the key benefits of itemized sale is that you do not really inherit, the buyer doesn't inherit any past tax liabilities or risks of the seller when they acquire these assets. But at the same time, there is a section called 281 in the Income Tax Act, which talks about obtaining a tax NOC from tax authorities. So basically, 281 has a risk, which is because 281 says whenever a buyer is acquiring any of the specified assets from a seller, and there is a definition of specified asset to say plant, machinery, shares, those kind of assets are defined in that. So when a buyer is buying these specified assets from a seller, and thereafter, if there is any tax liability on the seller, which the seller is not able to fulfill, then the tax office can go ahead and recover these liabilities from the buyer and regard this transaction as void. So typically when you are doing an itemized sale, while there is no succession of past tax liabilities, one needs to see if there are any of these specified assets which is being acquired, which you need to kind of have a protection against. So that is one aspect to be looked at. From a seller perspective, whenever these itemized sale occurs, there'll be capital gains, or depending on the category of assets, you will have to see what kind of income is it taxable to. Where there is a sale of depreciable assets, the computation mechanism as per section 50 will apply. You will first reduce it from the block and so on and so forth. Where there are certain categories of assets such as land and building or unquoted shares, one needs to also look at section 50C or 50CA, which lays down what is the minimum value or a consideration which will be regarded as sales consideration for computing the gains of a seller. So that's something which needs to be looked at. And like Deepa mentioned earlier, when you are doing an itemized sale, GST also applies on asset sale. So one will need to see what is the type of asset and which category bucket does it fall into for GST applicability. I'll just move on to the next part. Here it's more about, it's just a broad comparative between a slump sale and an itemized sale. And while we did cover it while going through the earlier slide, just for a recap, business sale is a sale of undertaking on a going concern business. It needs to be for a lump sum consideration. Capital gains are as per the prescribed formula and there is no GST. Whereas in case of itemized sale, there is consideration assigned to individual assets and liabilities. Capital gains have to be computed for each item and there will be GST impact. And this is just key points which are summarized. Of course, there are various other nuances which needs to be looked at. I'll just pause here and request Deepa to take over this mergers and demergers part, and maybe we'll take up all the questions towards the end.
Yeah, okay, sure, Manali. Thanks. Yes, Manali, we can move forward. On the topic of mergers, we all see it on a daily basis that various companies are merging, and it's either within the group or it is third party commercially agreed mergers. And as you can see on the left hand side, what happens in a traditional merger in India is that one entity merges into another entity and ceases to exist. So, in this example, if company A is merging with company B, there will not be any more company A and it will cease to exist. And there will be only company B who will be continuing to exist. The company B, as a consideration of this merger, will issue shares to the shareholders of company A. And therefore, all the shareholders of company A will become shareholders in company B as well. Therefore, what it means is that typically in India, a merger involves transfer of all the assets and liabilities. And the company law prescribes procedures whereby approvals are to be obtained from various stakeholders to approve such mergers. As you can see that, in the past, we've had various mergers, and all of these commercial mergers, the shareholders have approved, and some of them have also raised objections, and these have therefore been addressed by the courts. And now, as a process of this merger, there are notifications which go to authorities as well. So it is not only say the shareholders or creditors who get to have a say. The regulators also have a say in approval of this merger process, and the NCLT takes into cognizance all of the viewpoints which arrive from various regulators as well as stakeholders before granting an approval. And it typically takes around 8 to 12 months, depending on which part of the country we are going to, the NCLT, which NCLT are we going to, and what all are the nuances in such mergers. Yes, Manali, let's go forward. Some of the important things which we have dwelled into in the past, and this is just a simplistic highlight of it, and we are discussing matters which are more generic here, but just taking you through some of them. Basically, there is tax neutrality to merger only if you fulfill conditions which are specified under section 21B of the Income Tax Act. And that section actually talks about all of these things, whether all assets and liabilities are transferred, whether all shareholders, at least 75% of the shareholders become shareholders in the amalgamated company. And there are conditions pursuant to which you could claim the brought forward, the carry forward losses and unabsorbed depreciation, because that forms an important point to consider whether or not this all will be carried forward. Similarly, there are benefits like MAT credit or 10A, TIA. I mean, now we are in a zone as a country where we are phasing out of benefits which were there in the past. But at this stage, presently, when we look at any merger or amalgamation, we have to check what are the benefits and how much will it continue or get lost. Similarly, like input tax credit, or there could be various other deposits with authorities. There could be land lease premiums which would have been paid. All of these things need to carry on and get into the amalgamated company. So those are some of the key things which we would see. The additional point is on depreciation. Now, whether when you look at amalgamation, how will the depreciation work? And this has to do with appointed date, because typically the amalgamation is taking place from a defined date in the scheme, and therefore the depreciation becomes allowable on proportionate basis on all of these schemes, all the amalgamations. Similarly, other consideration is what happens on merger costs, because today we are looking at say in-house intra-group mergers, but at times, like we saw on the previous slide, there are a lot of third-party mergers which happen wherein a lot of money is spent on say either advisors or stamp duty or various other things which need to move from one entity to the other. Now, all of these are bucketed as merger expenses. However, whether law allows, that is Income Tax Act allows a deduction of all the expenses, that is something which need to be seen expense by expense. But typically, directly relatable expenses to the merger are amortizable over 5-year period. When you look at a merger, the first question which comes in the mind of shareholder is, I have held the security now for a long time, and say for example it's a listed security and there is a merger happening. The question could be, what is the cost of acquisition of my new shares which I have received on merger? Whether I will get a period of holding, because that, say for example, the person has held the shares for already for more than 24 months in an unlisted security, or more than 12 months in a listed security. Then if the person sells the shares the next day, then whether it will be long term or it will be short term. So you would get the cost of acquisition, period of holding, for the mergers, and in the hands of shareholder, the older cost of acquisition of the amalgamating company becomes the cost of acquisition of the amalgamated company. Another question is with respect to the assets which are getting transferred. Now, what happens to the cost of acquisition of such assets? So, whether in case of capital asset, the amalgamated company or the transferee company gets the full cost basis. The answer is yes, that the intention of law, and this is all provided under Income Tax Act under various sections, that the cost basis moves from one entity to the other once the merger happens. So broadly, we have covered. Now there are some of the points on the left hand side, some of it is uncovered, and I would want to just quickly go through them. Like we discussed, in every merger, there is an appointed date and an effective date. Now, what is an appointed date? Appointed date, as you may already know, is a date wherein, with effect from, you are going to combine the entities. So it could be a date, and there are circulars under company law and past precedents under Income Tax Act basis, which view has to be taken as to how long back can you go on an appointed date, or how forward can you go for an appointed date. So appointed date is a date which is decided by the board and the shareholders as a date which will be taken as a date from which the merger will be effected. And there is a judgment in the case of Marshall and Sons, basis which a position is taken that under income tax law, whatever appointed date is chosen and approved by the court, that will be taken as the appointed date for income tax purposes, and all of the points which we discussed in the right side box will get effected from the appointed date. Effective date is a date when the court is approving this and the order is received and filed with the ROC. Basically, there is a process under NCLT or the company law, wherein the NCLT order is received by the applicants, and the same needs to be filed with the ROC to make it effective. And once you have done the filing, then you can say that the merger is now effective, and that gets effected from the appointed date. Sometimes, we do have complicated holding structures. So the shareholders typically, as you would envisage, could be equity shareholders. However, there could be complex securities like optionally convertible shares or preference shares, which are compulsory convertible. What happens to those? So basically, you will need to have a consideration which is specified for each of the holders, which is equity and preference shareholder, and you will need to issue consideration to all of them. And when the law, which is 21B, talks of shareholders becoming shareholders, it does not distinguish as to which shareholders become shareholders. Therefore, all of these shareholders will need to become shareholders. At least 75% need to be holding the shares of the new entity. Um, and therefore, there is no distinction as such. Now, the question is whether on this merger, can we issue preference shares only instead of issuing equity? So the law is silent with respect to this, and many corporates have in the past issued preference shares in lieu of equity or vice versa. Typically, if you have a valuation, and the valuation will need to be done by a registered valuer here as per rules of NCLT. So if you actually have a valuation report, uh, that is the starting point to say that you are actually discharging full consideration, whether it is by issue of preference shares or equity shares, it doesn't matter. But there will be a complexity if you ask me a question that I want to issue both equity and pref in different proportions to different shareholders. This answer could be different. So basically, what I mean to say is you could issue either equity or pref, or you could issue both. But if you plan to issue both disproportionately, then there could be an issue. Therefore, it is always advisable, uh, in order to have this as a tax neutral merger, to have in a proportionate manner shares issued to all the shareholders. We discussed on the tax holiday benefits. Basically, there are various sections whereby tax holiday benefits were existing, and these actually, in order to be transferred into the new entity or the amalgamated entity, these there are different conditions. So, for example, 80IA is not permitted to be transferred. However, 10A could be transferred, but with effect from 1st April. So there are various um, things you need to be cognizant of, and this is a question which you may ask upfront to your client, that what are the benefits which are sought. And we are talking right now of, say, direct tax benefit. There are indirect tax benefits, say PLI, etc., various other incentive schemes. Then what happens to those? So those all need to be checked scheme by scheme, and what is the period remaining, and how the transferee entity could satisfy those. So that is something which needs to be checked. And another point is with respect to MAT credit, and there was a judgment in the case of Skoal breweries, and thereafter there were many judgments wherein the sorry, Manali, the slides have moved. If you can go back. Thank you. So there the MAT credit, it has been held MAT credit can move from a transferor to transferee. Um, we discussed on the change in shareholding and lapse in losses that you would need to satisfy industrial undertaking definition under 72A in order to transfer any losses or unabsorbed depreciation. And if the amalgamating entity does not satisfy that, then the losses will not move. Yes, Manali, we can move. So here on the slide, we have put various cross-border merger situations. And the first two merger situations, which are demonstrated on the first half of the slide, the top half of the slide, uh, those are the ones which are tax neutral as per law today. So when two foreign companies merge, pursuant to which there is a transfer of India company shares, if that satisfies two conditions as prescribed under Income Tax Act, this has been held to be tax neutral. So if shares are issued, at least 25% of the shareholders become shareholders in the new entity or the amalgamated entity, and the merger is recognized in the law of the foreign country where these are resident, then this would be exempt. There are also rulings on this Hex 10 Canadian company wherein this has been upheld. Similarly, we have seen of late that various foreign companies merge with Indian companies, and that could be due to multiple reasons. And one of them, for example, could be that we as Indian companies are also sometimes owned by NRIs, and there are various intermediate jurisdictions wherein people now do not want intermediate jurisdiction due to various issues, or say for example the entity has outlived its utility. For all of these reasons, there could be a merger of foreign company into India company. This also, with certain satisfaction of conditions, could be exempt. What is not exempt, and which our government has been kind of wanting to free up, but somehow certain loose ends are remaining, is a merger of an Indian company with a foreign company. Now, as we all know that today there are many Indian promoters who want to list the Indian businesses outside. You would have heard of various structures whereby earlier people wanted to list on, say, London or Singapore exchanges, and now it's US. There are various exchanges whereby people would want to list their securities, and this structure actually is helpful on that count. But as of now, only Companies Act permits this, and income tax is yet to kind of make this tax neutral. So we are waiting on this last structure to get a go ahead and get a tax neutrality on this. Yes, Manali. You want to pick up Demerger, Manali?
So, coming forward to the demerger piece, in case of demerger, what happens is demerger works again on the concept of an undertaking. Demerger says that, where you need to transfer a piece of your entity, not the whole entity, but you want to transfer a business which constitutes as an undertaking, then you can do a carve out of that undertaking by way of a demerger route. Demerger in terms of the processes work quite similar to a merger, where you need to go to an NCLT, run through the whole NCLT process, need to take approvals from various authorities and get the demerger approved. Demerger is where, say here in the diagram, left hand side is represented where a seller wants to demerge unit 1 to the buyer. The buyer company will in turn issue shares to the shareholders of the seller company in the fair share exchange ratio based on the valuation report which is obtained. And the whole arrangement could be tax neutral, provided these shareholders are getting minimum stake in the buyer entity. All the assets and liabilities of this business are getting transferred to the buyer, and so on, as per the 219 AA requirements. In terms of the tax implications, if you are able to comply with these conditions, it will be a tax neutral movement of the business. In terms of tax losses, what happens is it's already captured in section 72A, where if you are doing a demerger, there is a prescribed ratio which is given. So either the losses are directly identifiable or attributable to the business which you are demerging, in which cases those directly attributable losses will move to the buyer. But in all other cases where the losses are not directly attributable, what happens is in proportion of your net assets which are getting carved out to the net worth of your whole business, that ratio is applied to arrive at the loss which should move to the buyer. In case of demerger, what happens is depreciation is allowable on proportionate basis to the buyer and the seller, depending on when your again appointed date for the whole transaction is. From a shareholder perspective, the cost of acquisition of the shareholder in the seller company, it gets split in terms of how much should be attributable to the buyer company, because the shareholders will post the demerger hold shares of both the buyer company and the seller company. Therefore, from a shareholder perspective, one will need to understand what is going to be the split of this cost of acquisition, which needs to be attributed to the buyer company, and what is the cost of acquisition which needs to be attributed to the seller company. From the perspective of the period of holding, the shareholders will get the period of holding from the period when they are holding shares of the seller company. The same period of holding will be available to the buyer company shares as well, when the shareholders want to eventually sell these shares. Another aspect was, and this has now been plugged in. So earlier there used to be a gap where demerger definition said that all the assets and liabilities which are acquired by way of demerger should be recorded at the book values at which it were appearing in the seller company. Whereas in Ind AS, there is, I mean, depending on whether you are a connected person, is it a business combination or not, one may have to record it at a fair value. So there was a gap between how the tax law is wanting, or how you need to record these assets as per income tax provisions to have the transaction being tax neutral vis-a-vis what you are required to do in the accounting parlance. This has now been plugged in, and there is a way out, given that in case if you need to account it for in case you need to account it at fair values, then even in that case, it will still be regarded as a tax neutral demerger. A couple of points to deliberate would again be, whether the unit which you are demerging, is it actually constituting an undertaking? Does it satisfy the undertaking definition? What happens to the tax holiday or benefits of the in case of demerger? Again, whether the ATIA carve out for amalgamation and demergers does not allow you for continuity. What will happen to the other sections or other benefits which you are availing? Whether the MAT credit will get transitioned to the resulting company or not. And one of the debate there is that the seller company or the demerged company, so to say, is going to be continued. It is not going to shut down itself. So it's a continuing business of the demerged company. All the tax filings and the tax attributes of the demerged company remain with the demerged company. And therefore, one of the view is that the MAT credit should also remain with the demerged company. Whereas, there are practically certain schemes where people have tried to move the MAT credit by putting this transition eligibility in the scheme document itself, and thereafter, having a debate that the scheme document blessed by NCLT should prevail over any other specific tax provision, and therefore that needs to be moved. So that's one of the other aspect which one may want to look at. Coming to the next point, and this is more so just to kind of summarize what we've seen so far and how one would see a business transaction or a merger or an amalgamation transaction, is that now we've seen what is a merger, demerger, what is a slump sale, what is an itemized sale. There are a couple of aspects which one typically looks at when arriving at what is the best suited for the transaction, and how one should go about identifying the correct approach or going about the correct modality for executing an M&A transaction. And while I've just listed few points here, there are various aspects to it. I am just taking you through few of them. One of the aspect would be, what are the tax risks and continuity of the tax risks. So, in case of, say, a merger, you are entirely taking over the entity, right? So, you are actually, in that sense, inheriting 100% of the tax risks of the company. Whereas when you look at a slump sale, you are restricted to the one previous year plus the period in which you are transferring the business. When you are doing an asset purchase, it is no taking over of these historic risks. So depending on when you look at the business that you want to take over or the business that is transitioning, one would decide what is the best mode to execute that transaction. Another aspect would be transaction timelines. Say mergers and demergers would run through an NCLT process and typically take a longer timeline to get executed, whereas a slump sale or an itemized sale could be a quicker process. But again, it depends, if a company is in a sector where it needs certain extra clearances, etc., then one needs to even look at the timelines which it will need to factor in while, comparing these alternatives. Another aspect is, what would be the costs of implementing the transaction, the stamp duty implications, actually the integration costs which will happen. Say if you are looking at a merger, not just taking over a business, but you will have to actually do the overall integration in terms of people, in terms of your processes, in terms of what kind of database you are using. So maybe both the entities are using different kind of databases. So how the whole integration will happen, or if it's a leasehold land transfer, the additional premiums which you need to pay to stamp duty authority. So those kind of costs are something which one will need to see in addition to the tax cost which will apply in each of these cases. What are the process related approvals, or are there any specific clearances which could be a hindrance? Say for example, if you are doing a court scheme, you may need to take approvals of your creditors. So whether you see a challenge in doing that, or whether that could be something which could really delay the timelines a lot. uh, Over and above these aspects which are quite commonly seen, one of the most crucial aspect, and which is something which everyone will agree, is what are the commercial objectives. Eventually, is the idea to acquire everything? Is the requirement only to have few pieces from the business? What is the commercial objective? Is the seller really not wanting to retain anything at all? Do they want 100% exit? Whether the buyer is interested in everything, or does it really want a piece of the business? So a lot of these commercial aspects will be an overarching umbrella which will drive each of these smaller other aspects as well. And I think that's something which one will have to be more conscious of while evaluating any of these options. With that, I think we've covered about these topics in brief, and I'm mindful of the timeline here. We have one more topic to cover. Deepa, you have anything to add? Otherwise, we'll move to the questions.
Now we can move to the questions. I think there is
Okay.
one question which came around valuation of a slump sale.
Okay. Good morning, everyone. I would like to take ahead the question and answer session. So, as Deepa ma'am said correctly, we have a question that whether the valuation for slum sale is done by specified person or from anybody.
So there are on the typical valuation which is done for the slump sale, wherein the board and the shareholders approve, that should be done by an independent valuer, wherein the values can be justified at a later date. There is also a minimum 11 UAE valuation which is done, which is at the time of 50B, the certification at the time of tax audit filing, which is typically done by the auditor.
Okay. Thank you. There's one more question. If a wholly owned subsidiary gets amalgamated with its holding entity, will this be tax exempt? And what will be the scenario if this is a cross-border merger?
So, Manali, please feel free to add. If a wholly owned subsidiary is amalgamating with its parent, it still needs to satisfy the conditions which are prescribed under 21B for it to be exempt. And if this is cross border as well, it will need to still satisfy the conditions which are there. Except that if it's a wholly owned subsidiary, no shares will be issued. That is understood. However, all other things will need to be satisfied.
Okay. The session was so explanatory that we don't have any further questions. It is my honor to get this opportunity to thank all you dignitaries present here. On behalf of the Women Members Empowerment Committee of ICAI, I would like to extend my heartily vote of thanks to all the members in the webinar for their presence and contribution so that to make this seminar success. I would like to extend my gratitude to our honorable speakers, CA Deepa Dalal and Mansi Mehta, to take out time from their busy schedule and be present here to acknowledge us on the topic of mergers and acquisition with their great knowledge in this area. I would also like to give a special thanks to the chairperson and vice chairperson of the Women's Member Empowerment Committee for organizing and providing their immense support for the success of this seminar. Lastly, I would also like to thank the volunteers and the organizing team members for working for the past few days to make this webinar a success. Thank you. Now I would request CA Kritika Bahu to introduce us to our next speaker for the day, CA Mitra Vijayarama. Thank you.
Thank you
You
so much. It
all.
was our pleasure to be here, and thank you to for giving us this opportunity. It was our pleasure to be here. Thank you.
Thank you very much.
Yeah, good evening to all. It's my pleasure to introduce the speaker of today's session, second session, CM Mitra, to the forum. Mitra Vijayarama completed her MCom in the year 2005 and she became the Associate Chartered Accountant in the year 2009. She worked as a senior executive in Wipro BPO until 2011 and started her practice from the year 2011 onwards as a partner in Srinivasan Associate, Chennai until 2020. After 2020, she started her own firm, Mitra Vijayarama and Co. And she completed her visa in the year 2015. She handled various statutory audit of banks, internal audit of hotels, education institution, trading agency, etc. She also handled statutory audit of private limited companies. Her interest is in reading books, listening to music, etc. With these few words, I would like to give the forum to CA Mitra. Thank you, ma'am.
Good evening, everyone. Can I start sharing the screen? Topic is I have taken as internal audit of an educational institutions. Before I get into the topic of internal audit, I would like to give a brief background of the educational institutions in India. The concept of education has always been synonymous with charity. This was delivered in a judgment. Yeah. Thank you. So, with this concept of charity, and in India, the educational institutions are run by either public trust or societies registered under Societies Registration Act 1860. And out of these both broad heads, you have government institutes, government aided institutes, and private sector institutes, which is run by the private managements. And this is a brief organization structure chart of the educational departments in India. It comes under the Ministry of Human Resources Department and from the central government, and you have a state level Ministry for Human Resources Department, and under that you will have a Department of Higher Education. And in the right side, if you see, I have written few points with respect to the approval and the affiliations with respect to the courses. The approval to run a college has to be available from the Department of Higher Education, and depending on the courses which the management choose to give, so the affiliation differs. If it is for arts and sciences, it has to be to the respective universities. If it is for technical education, it has to be taken from AICTE. If they have to go for a teacher's training or a related education system, then they have to go for National Center for Teacher Training. And the department, the educational institution departments within the educational institution, the departments can be divided into two categories. I have categorized into academic and the administrative part. If you see in the academic, it takes part of the academic parts of the college, like the quality of education, quality of the courses, what are all the extra courses or the talents which can be identified and the students can be motivated. Those things would be done by the academic department. And when it comes to the administrative department, we have some few more departments like human resources, stores, engineering, security, accounts, canteen, and EDP. So this accounts is a center for all the departments, as we all know. So that's why I have mentioned it in the center. And the topics which would be covered today will be Accounts, under accounts, we will have revenue, expenses, fixed assets, receivables, and liabilities. Under HR, we have hiring, training, hike, promotion, and exit. Under stores, purchase and stock maintenance. Under engineering, contract approval, execution of contract payments. Transport, fleet management, required documentation, route approval, and sale of vehicles. Under software, it may be procurement of software, maintenance, data security and renewal, and then canteen. And with respect to revenue of an educational institution, the main revenue comes from the tuition fees from the students, and we have the other income. This tuition fees from the students, and then examination fees, and again other fees, which is further explained in the next slide. The fees from the students is basically the tuition fees or the term fee which the institution collects from the students. It is decided based by the guidelines given from the respective state governments, and with the cost of the management also. So it has to be accounted or cross-checked with the number of students with which they appear into the examination. There are cases where the students come into the institution, they register for the courses, but after that they do not continue for the courses, where they don't write the exams. But the fees would have been fixed for them, so it will turn out as a bad debts for the institution. So the care has to be taken when it is being accounted for by accrual basis. Because if the student doesn't appear to the exams, then it becomes a bad debt. So we need to check with the university examination sheets, like the data sent to the universities for the examination, that has to be cross-checked with the number of students and the fees actually accounted. So it has to be done on a periodical basis, say either to 6 months, or depending on the time of the exam under the board which they are studying. Then you have a scholarship or waiver of fees. A lot of trusts give waiver of fees to the students. They will have a specific guidelines based on the management. So the management guidelines and the actual waiver of fees which is given has to be cross-checked with the waivers given, because some of them might misuse the waiver actually given by the management. So care has to be taken for this particular area. And the same applies to the scholarship. Scholarship is given by central government as well as the respective state governments also. And some of them now have changed the mode of sending the fees to the students' account. Earlier, it was to the principal account, that is the separate account has to be opened by the college or the education institution principal, and the scholarship amount will be sent to them based on the pending fee from the student. The amount will be adjusted. But nowadays, the governments are sending to the students' account directly, where it becomes hectic to collect back from the students for the management, because most of the students do not remit the fees even though they receive the amount from the government. So care needs to be taken here, and the management has to work out some policies or procedures to collect the fees from the students here. And the control over receipts, books, and billing. With respect to this, only one, the institution might be big, so there may be 2 to 3 areas for the collection of fees. So care has to be taken to over the control of the receipt books or the billing. Even if it is done from the software has to be properly used by the proper person. Only authorized personnel for collecting the cash and making the receipts should be authorized to make the receipts and enter the accounts. And then you will have this examination fees. Examination fees, again, I have bifurcated into with fine and without fine. And one more thing is lack of attendance fee. This examination fee, why I have mentioned separately is this has to be remitted to the respective universities or board of education under which they study. The entire fees collected has to be remitted. There should not be any balance pending in this particular account. So we need to ensure how many students are appearing for the exams, whether the number of students have paid the fees, whether it is with fine or without fine, that working has to be cross-checked and the same is remitted to the examination, the examination department of the university within the due date given by them. And this lack of attendance fees with the respect to the students who do not come to the colleges regularly, there may be a condonation of delay. Even that has to be cross-checked with the attendance sheet, whether the particular student has paid the condonation delay amount or not. That has to be cross-checked. To overcome this one, the management can decide to include this part in the software also, where it gives a pop-out based on the number of days leave to a student to collect the lack of condonation delay fees if there is any, if there is a student who has taken much leaves in that particular semester or the examination pattern. And with respect to other income, you have bank interest, other fees collection. Bank interest, there may be FDs or short-term FDs or long-term FDs depending on the management's decision. So these FD slips has to be cross-checked, and bank interest we can cross-check with the Form 26A and Form 16A, which is given by the banks or the person who deducts the interest on time from time to time basis. So this has to be cross-checked with those things. And you have other fees collection, which comes across like book fee, record fee, lab fee, breakage fee, TC fee, all these, and you have miscellaneous fee also. They collect different name of fees. These has to be cross-checked with the number of students, and when it has to be collected from the particular student. So if it is a TC fee, the TC fee has to be accounted as accrual income only when he leaves out of the college. Otherwise, it should not be accounted. So we need to check whether when these revenues should be accounted, whether it is accounted on a proper basis, like the number of students record and the number of the amount of the fees collected matches or both does not match. We have to be very careful with that. If the management uses any software for all these students' data, then periodical verification of the software data with respect to the amount collected, amount spending has to be cross-checked with the accounting part also. They may use a Tally or some other ERPs for accounting purpose, and they may use different softwares for students' data purpose. Both has to be cross-checked with the amounts to be received and the amounts collected, so that there is no difference. If there is any difference, that needs to be reconciled on a time to time basis. Otherwise, it will result in different amounts in both the datas. And they may conduct a workshop, or they may give the premises to the examinations like typewriting examination or UPSC exam, whatever it may be. So they get a revenue from that. But some of the revenues will not have the portion to the management, that the educational institution. That will be only to the teachers who work as the invigilators to the exam. So care has to be ensured that whatever money received from the revenue for this particular examination thing, whether all the amount, is there any part of income to the management, or the entire thing has to be remitted back to the teachers. If it has to be remitted back to the teachers, whether they have remitted back or not, that has to be checked here. And with respect to grants or donations, there may be donations received from the resident Indians from other countries also. If it is resident Indians, we need to check with respect to usage of the donations given, whether it is for corpus donation or for general donation. If it is for corpus, the internal auditor has to verify whether the donation received is parked in a separate account and the usage is done as per the instructions given at the time of the donation. If it is received from other countries, we need to follow the Foreign Contribution Regulation Act. We need to give the year-on-year forms which are required to be given under that act, and we need to get a certificate from the chartered accountant also for the amount received and the amount utilized under foreign currencies. And there may be grants also with respect to the educational institution. Those grants has to be checked whether it is received for the purpose of acquiring any asset or for the purpose of any income. So according to the grants received and as per the accounting standards 12, we need to account the grants received, and utilization of grants also has to be cross-checked with the conditions given during the time of the grants by the government. So if there is any condition which is not fulfilled, they may end up with returning back to the government. So TAR has to be ensured. I mean, they need to check whether all the conditions have been fulfilled with respect to the grants and other things has been fulfilled. And there are, this is with respect to expenses of an educational institution. There are various expenses, only few have been discussed below. Those are affiliation fees, salary, repairs and maintenance, software license fee, and payments relating to transports. Affiliation fee, as we discussed earlier, the universities or the Board of Education, they will get affiliated to for the course they conduct. This affiliation fee is has to be renewed on a periodical basis according to the instructions given by the universities or the board under which they get affiliated. So this affiliation fee has to be cross-checked with the letters or the circulars received from the institution, whether they have paid within the time and a number of, and they will also inform you about the number of intake of students which they need to, the management has to take. Under each course, they will have a number of students intake. So that whatever the number of students admitted and the number of students intake as per the affiliation has to be cross-checked with the to ensure whether they do not cross the limit fixed. And with respect to salary or payroll, salary is the next expense which is very high expenditure on the educational institutions. So care needs to be taken. We need to check the payroll, whether they have calculated based on the leave cards and the based on the appointment letter, whether their salary is fixed, whatever allowances the employee gets, whether it is as per the appointment letter to that particular employee, that has to be checked. And if there is any hike or something like that, that has to be also cross-checked. So this has to be matched with the Provident Fund data also, where they are eligible to pay the Provident Funds. The number of headcounts with respect to this payroll sheet and the Provident Fund has to be cross-checked. Sometimes the PF Provident Fund websites do not allow them to pay if there is any small changes even in the name entered. So that becomes pending for payment. So that has to be taken care whether they have paid after the correction in the name part and they have paid the Provident Fund of that particular employee. This needs to be cross-checked, and the payment mode, whether it is through bank or through cash, that has to be matched with the payment made and the and the payroll sheets. And repairs and maintenance may be into the building or into the office office computers or whatever it may be. So that has to be checked for the amount of the repairs and maintenance which they have spent, whether it is within the with the management approval or is there any deviation from the approval given. Care has to be ensured with respect to the payment of amount to the vendors. They have to deduct TDS, and whether proper amount, proper rate of TDS deduction is being done or not, that has to be cross-checked. If there is a lower rate of tax reduction, then they have to, the internal auditor has to ensure whether they have collected the lower reduction certificate from the respective vendor under section 197. Otherwise, it has to be reported to the management that they have made the lower reduction, but they have not collected the lower reduction certificate. That has to be informed to the management. And with respect to the software license fee, you will have they may have an in-house software or the software procured software. This comes when it is procured. The software license, whether it is renewed properly and the payment is made to the software licensing software agency properly, that has to be ensured. And if there is any agreement with the software company, whether all the services, whatever they have agreed to when they provide the software, whether that has been provided properly or they are, providing on a periodical basis, that has to be checked with their billing and the agreement and the payment which we make. Then payment relating to transports, there may be fleets, which we will discuss in another slide also. With respect to the payment relating to transports, there may be payments to the diesel agencies, which would be done on a periodical basis. CAD has to be taken here because there may be a misuse in the filling of the diesels. So generally the educational institutions follow a method of giving a token to the drivers who drive the vehicle, and that particular token will be serially numbered, and they will inform the respective diesel agencies the token number, and they will do a cross check also for this particular thing. So if the serial number tokens are not, they will have a copy of the token numbers at the institute also to cross check. If the serial number do not follow on a random, on a proper basis, if there is any missing in between, that has to be cross checked why this particular token is not available and who has used it, whether the usage of the token is with approval or not from the management, or they might have a separate transport department, whether it is with respect with the approval of the transport department they have done. That needs to be ensured to avoid any unnecessary payments in respect of the transports. And we have a fixed asset management here. The purchase of fixed asset, the method used for the purchase of fixed assets, whether is there any procedure relating to the purchase of fixed asset, or they do not have any procedure, written down procedure or standard operating procedure has to be checked. Whether they collect the quotation from the respective vendors before they enter into a purchase, whether those quotations are actually verified out of the market also. So that also has to be cross-checked. And is there any periodical verification for the fixed assets, already purchased fixed assets? Whether they conduct any periodical verification. Is there any difference between the difference in the number of assets, or is there any obsolete assets? Something those has to be verified and reported to the management. Is there any scrap out of that? Whether those scrap can be sold, the GST part for those sale of assets or sale of scrap has to be ensured by the internal auditor. And the management can go for the tagging of fixed assets also. The internal auditor can inform the management to do the tagging of fixed assets also, to have a control over the fixed assets. And accounting part, the accounting of the fixed assets. Is there any issues? The accounting part can be ensured whether they have any issues with the accounting, whether it has been properly done or not. How do they account it? That has to be checked. Like whether they account it based on the invoices, or how do they account? That has to be cross-checked, because some of the accountants who work in the in educational institutions, they do not have much knowledge about the accounting part. So they may account the fixed assets in a different areas, or they may account in the repairs and maintenances also. So that needs to be cross-checked with the invoices available with the management. And if it needs to be taken as a fixed asset, that has to be transferred, and we need to educate them also on how they should account it. The internal auditor needs to check whether the accounting of fixed assets is done as per the accounting standards also. Then human resources. Human resources is another department of the educational institution where they take care of the employees and other things. Hiring of employees, whether the hiring of employees is done based on the interviews or through referrals, how it is done, that has to be checked once. And whether they give the appointment letters to the employees, whether all the terms and conditions are agreed, whether all the terms and conditions are already informed to the employee through the appointment letter, salary fixed, whatever the allowances which he is eligible for, whether that is given, that has to be cross-checked with the recent interview forms and the recent appointment letters, and the same can be matched with the payroll also. And the training given to the employees has to be documented. There they have a lacking in the documentation part of the training relating to the employees. So that this has to be documented so that the management will come to know how many hours have been used for training a new employee, so that if there is any issues with the employee, that can be sorted out. And next, job rotation, whether they have the job rotation of job roles in the department or in the management. Generally, they don't do this job rotation. So it is advisable for them to make this job rotation, so that none of the jobs, none of the procedures or the duties of the company will not stand if someone is not available. So care needs to be taken with respect to this job rotation. And hike and promotion, with respect to this hike and promotion, whether they have proper approval, proper management approval for a hike for an employee, for a promotion for an employee. Rules has to be, whatever the organization rules set for this promotion and hike has to be cross-checked with the actual hike and promotion given to each and every employee. On a random sampling basis, we can cross-check the details with the payroll sheet and the hike and promotion letters given to the employees, whether that comes within the rule or not. If it does not come, that has to be informed to the management then and then. Then whether, how do they manage the leaves? With respect to leave management, whether they print any leave cards and give to the employees and updated, or is it done only at the time, the details of leave are only collected at the time of preparation of the payroll? How it is done, it has to be checked. If they do not maintain any leave card, it is advisable to maintain a leave card. And the leaves, number of leaves taken with the leave card, and the same, whether the same number of leaves are deducted in the payroll can be checked before they make the payment of salaries. Whether the management follow any leave policies, like how many leaves to be taken forward, is there any leave credit, or all the leaves will lapse at the time at the end of the financial year or calendar year. Based on the rules set by the management, this leave details has to be verified with the employee's data. And the exit of an employee, is there any conduct of exit interview with the employee? The reasons which they give, generally the reasons which they give for the exit of an employee, that has to be analyzed. If the reason is repetitive, then care needs to be taken and it has to be informed to the management, and whether the management can sort out that issue for the exit of those employees, that has to be analyzed. And receivables is a major, I can say it as a problem to the educational institutions also, because it is actually based on the number of the students, but there may be dropped out students. The students may complete, but they do not come and collect the transfer certificate, and they will have a scholarship students. With respect to the scholarship students, the scholarship which they receive from the governments may come later. I mean, it is not on a prior, it is not on the proper periodical basis. If the first year scholarship is generally received during the second year or even during the final year, so the receivables figure will be shown on a higher side. So it has to be, we need to check whether how many students are under the scholarship, when they will receive the scholarship, whether they have already received, it has to be adjusted with the receivables. If it is respect to the completed, but the student has not collected the TC, care needs to be taken, because they might come to collect the TC at the time it has to be received from the student. So the main control should be kept with the TC records. If the TC records are available with the management, then the balances can be there in the ledger of the students. If the TC record is not available with the management, then they should not have any balances in the accounts of the student. Because if there is any balance and if the student has collected the TC, then it turns out as a bad debt. They cannot collect the receivables from the particular students. And the same applies to the dropped out also. The management can try to contact them and ask them to pay the fees and close the ledger, or it can be transferred as a bad debts also. So it depends on the amount of the bad debts or dropped out students which is available in the institutions. Then comes the stores. The stores purchase for the institutions can be done, for the colleges can be done either through the central purchase department or through the individual purchases, like each college will make their own purchases, or they may have a central purchase department which approves the procurement, the vendor which approves the procurement from particular vendor and the rate for the particular goods. All these things will be done by the central purchase department. This also has to be cross-checked with the quotations available with the central purchase department, whether they have collected quotations from the vendors, and it is the market price is also checked and recorded, and who approves the purchases. Is there any separate purchase manager, or the one of the management people will approve the central purchases? That has to be cross-checked. And maintenance of stock. How do they maintain a stock? How do they get in the stock into the institution? Whether they have any gate pass registered at the security gate, whether they write the gate pass with the proper details and put a MRN and bring it to the stock. Whether do they follow this process, or there is they just bring into the stores, or that has to be checked. And stock movement within colleges or within institution, whether what type of goods, what type of stock movements takes place. It may be computers for the other colleges, or it may be a stationaries required for the colleges. It may be anything, or it may move out of the college for a repair or for a maintenance. So if it is for a repair or maintenance move, the stocks has been taken, then it has to be with the returnable gate pass register. And if it is not, then they should maintain a non-returnable gate pass along with the stock which they send. How do they send the stock from the stores to the respective colleges? Do the colleges individually send an indent to the stores requesting them to give the number of stationaries or required systems, whatever it may be? So do they follow this procedure, or how it is done? The process has to be first checked, and then we can check whether is there any loopholes in the process, or how those loopholes needs to be rectified. That can be analyzed. And whether do they conduct any physical stock at the stores level at a periodic intervals? Is there any recording for those physical stock taken? If they have a records, we can cross-check with the records. If they do not have the records, then we have to ask them to maintain the records when they do the periodic interval checking. So that has to be mentioned in the reports also. And with respect to engineering, which does the work orders for construction, repairs and maintenance, for construction of a new building, or for repairs and maintenance of the existing building, something like that. So if it is for the original construction, whether they have obtained the proper approval from the respective authorities to conduct the construction, whether they have the proper planning, like if the building has to be built only with the 3 floors as per the plan, how many floors they have built. So these type of cross-checking also can be taken care. And whether they have collected any quotation from the vendors, whether the vendor stability is being checked from the engineering department, whether is he capable of constructing the whole building, or how is the engineer's capability, that also can be cross-checked. And with respect to the repairs and maintenance, whether they have collected any quotations from the vendors, do they do any market check also for the sparse rate or available in the online shopping or something like that? How do they make the procurement, and whether it comes with the approval from the engineering department for the particular purchase. The engineering department has to certify, and it has to inform that they need this particular product, or this particular repairs and maintenance has to be done within the building, or within the electrical systems, or within the furniture and fittings. It may be anything. So the request from the engineering department has to come to the management. So based on that only the work orders or the execution of work orders can be done. The engineering department also takes care of the execution part. So it takes whether as per the agreed rules with respect to the construction or agreed timelines, whether it is being done or is there any extension required, or the rates paid or as per the terms agreed with the vendors, is there any deviation from the rates, or is it sometimes there may be a change in the market rate, again there may be a rate escalation. If there is a rate escalation, that has to be approved with the proper approval, like the management people or the Department of Engineering has to give the approval for the rate changes. And completion. The completion is important because the completion has to be done only by the engineering department. Like they have to give the certificate that the work has been completed and the vendor is eligible for getting the payment from the accounts department. Without this document, the accounts department is not allowed to pay. So we will have a control check here with respect to the works contract for the construction or the repairs and maintenance, whether it has been, the completion is certified by the engineering department or not. And fleet management, the institution may have a number of vehicles. It may be cars or buses for the travel of the students. So the list of the number of vehicles to be obtained and the documentation of the vehicles. Documentation of the vehicles in the sense whether the vehicle is available with the proper FC fitness certificate from the RTO, or they have paid the proper road tax and the green tax which they need to pay. So whether all these are available with the vehicle, and they should have the trip sheet, updated trip sheet. If the trip sheet is not updated, then it has to be reported with the management. And the route they apply for bringing the students and taking them back to their home, whether the route has been they have got the route approval for the flying in that particular route, whether that route approval is available for all the routes they fly in the surrounding area of the colleges. That has to be cross-checked. First, the number of routes they fly and the route approval, whatever they have got, that both can be matched. And with respect to insurance, whether all the vehicles are insured, whether they have paid, proper documentation for the insurance within the vehicle or not, that has to be cross-checked. And in the insurance policies, the name of the management, whether that does it appear in the insurance premium paid receipt, and in the document of the vehicle, in the RC book of the vehicle, whether the management name appear in the name of the owner, that has to be cross-checked. If it is bought from the second hand or something like that, then they have to make the name change within the proper time, and they need to keep it in the vehicle. So if there is any checking during the transport of the vehicle, then it has to be shown. So care needs to be taken here, whether they have the proper documentation in the vehicle. The internal auditor can make a surprise check also with respect to this part, where they can get into the vehicle and check whether all these documentations are available with the driver. And they can also cross-check the driver's license. It can also be checked and reported to the management if there is any drivers who carry the expired license. It has to be properly renewed, and they should have a proper calendar like thing for all these renewals of the road tax, green tax, and fitness certificates of the vehicle. If there is any renewal not done, that needs to be reported to the management. If the management doesn't have a calendar, it is better for the internal auditor to prepare a calendar and give it to them, so report it to them, so that it will be easy for them also. Is there any sale of vehicle during the period where we conduct the internal audit? How does it been sold? Whether they have any proper approval, like whether the management has approved for the particular sale of a vehicle, and how it is being sold. Whether they have collected any rates for the vehicle, how much it can be sold. That quotation has been collected. Whether the quotation amount is properly approved by the management, that also has to be ensured. And GST part also has to be taken care for the sale of vehicle here. And if there is any deviation, that has to be reported with the management. And then you have software. As I told earlier, it may be a procurement of software or in-house software. What are all the details available with the institution, that has to be verified. And usage of software, whether they have any restriction with respect of accessibility to the employees. The level of employees may be categorized, and the clerk level employee may have certain access to the software, and the management level employee may have a certain level access to the software. So this accessibility of softwares to the employees has to be tabulated, and we need to see whether it is as per the accessibility given, the systems has been accessed, and if there is any deviation from the accessibility actually given and actually used, that has to be reported to the management, and that has to be analyzed also who have used this particular level of software when they do not have the approval for that. That has to be checked and reported. And this can be done using the login reports, which we can get from the softwares. And the renewal of the software, whether when does it become the time period for the renewal has to be checked, whether it is renewed on proper time, and whether they renew it based on the same agreements which is entered earlier, or is there any additional provision of services with respect to the software, that has to be checked. And the billing of the software has to be compared with the agreements which we enter with the software companies or the software vendor, whomever it may be. If it is an in-house software, the upgradation of software needs to be verified often, whether any virus attack is there, whether any malware is sitting inside the software, whether any bugs are there for software to run properly. That has to be checked on a periodical basis to overcome those bugs or virus or kind of those things. And with respect to data security, how secure are the data available in the institution? Whether do they take any backup of accounts as well as the software, if they maintain anything for the students' data, whether any backup is taken for those things, what periodic basis they follow to take the backup for the data. If it is not followed properly, that has to be written. That has to be written in the report and informed to the management. If they follow a backup properly, whether it is kept in a secured place, whether it is kept in a secured system, or is it in cloud, or that has to be ensured. If it is in cloud, who has the accessibility for those backup of the software data and the accounting data has to be cross-checked. Installation of CCTVs. Installation of CCTVs is done at all the institutions, but whether it is working or not, how many number of cameras are installed, whether are they at the proper places, whether someone is assigned to view the monitors, do the monitoring of the particular cameras, or that has to be checked by the internal auditor, because some of them they may have some issues with the CC cameras, it might not be working. So we need to check now how many number of cameras are installed, how many are in working condition, whether how many is not working, what is the reason behind that. That has to be identified and reported to the management. Whether they have a backup for this camera recording also, how many is backup they maintain, that has to be checked. And those backup data, where it is being stored for with respect to the CCTV data, where it is being stored, that also has to be cross-checked. And then installation of fire extinguishers, how many fire extinguishers are installed inside the buildings, how many is within the expiry date, or how many has been expired already, whether any procedure is taken for follow-up is taken for renewal of the same, that refilling of the same, that has to be ensured. All these fire extinguishers has to be done with the approval of the proper fire officer from their respective area where the college is being situated. And these whether the employees also have a knowledge of how to operate the fire extinguishers. This also has to be checked, because in case of an emergency, If they do not know to operate the fire extinguishers, then there is no purpose of keeping the fire extinguishers there. So it is to be checked whether they make any training to the employees regarding the operations of the fire extinguishers. Then it comes to the canteen, whether it is in-house, that is the food is prepared in-house, and we need to check the procurement of provisions or food items, which is for the in-house usage of the canteen. The FSSA registration number, whether it is available there in all the packed items, all the biscuit items, or what which they procure locally. If they procure locally, that has to be cross-checked. This can be checked on a surprise check with respect to the stores of the canteen. That can be done, that can be identified. And if it is outsourced, we need to cross-check the agreement, what we have entered with the vendor, what are all the services which he is supposed to provide as per the agreed terms, whether he has provided all those and his billing covers those aspects only with respect to the outsourced canteen. And cleanliness also can be checked once in a while by the internal audit team, whether it is safe, whether the food items are kept safely, and whether it is the surroundings are kept clean or not, to maintain the hygiene of the students. So this also can be checked as an extra mile by the internal auditor. And I hope I have completed within the time.
Hello, ma'am.
Yeah.
I have one question
Yes.
regarding these educational institutions. They even give their stilts or sometimes open grounds for marriage functions and all
Yes.
other activities. So how are we supposed to check whether everything is in place or no?
First, we need to first check the trusted it, because they cannot just like that do these things. We need to check with the trusted it. They can give it for the conducting sports events or something like that. So this aspect has to be checked with the trusted it. And if they collect any amount from them, that has to come under the 20% of that is general public utility clause is there in the Income Tax Act. Only they have to account in that particular aspect only. They cannot bring it as a main revenue.
Okay, so it can be as an ancillary activity for them.
Yes, yes. Some of the institutes, they prepare the cricket grounds. They make it. They facilitate those local associations to come and take the ground and play. So in these cases, they do in like that only. Before that, they may enter into an agreement also with the particular party, so that if there is any issues, that can be avoided.
Okay, so similarly, when the bus activities and all those are carried out, they can give it under contract, under the contract, but the same cannot be accounted by them as their income within the institute, right, ma'am?
Yes, they have to account within the institute, but we have to see this 20% cap in that. It has to come only in the general public utility. I think this marriages will not come into that, but if they give it for the sports event, then it can be done.
So the marriage activities will not be good. It will be completely
marriage activity, because the trust the object of the trust will not be like this, no. So we need to check the trust deed also.
So it will be like other source income, exactly, right?
Yes, yes.
Okay. Thank you, ma'am. I think it is self-explanatory.
Okay.
Okay. Any further questions will be there?
I hope I have covered the maximum part, whatever it is required.
Yes, ma'am. Shall I continue with the vote of thanks, ma'am?
Yes.
Okay. So a warm and graceful evening to all present here. It's my privilege to propose a vote of thanks and acknowledge the contribution of those who worked hard to make this symposium possible. I'm Mansi Patil on behalf of Women Members Empowerment Committee and entire fraternity of ICAI. Extend my sincere thanks to all making this entire event a great success. Today we had a great opportunity to hear the thoughts and had excellent coverage of the topics by our speakers, CA Deepa Dalal, Manali Mehta, and CA Mitra Vijayarama. And this will surely help us in our practice. Thank you, Chairperson CA Supriya Kumar and Vice Chairman CA Preeti Savla for conducting and managing the committees with excellence. Our sincere gratitude to all the participants for their support and encouragement. Thanking all the coordinators and lastly technical staff, Mr. Hemil, for conducting the symposium smoothly and hassle-free. Today's topics were self-explained and very well taken up by all the CAs. Thank you. Technical staff, please close the session. Thank you.
Thank you, ma'am.
Thank you.